So, for many of you exploring international property, the idea of buying in Phuket, that's Phuket, pronounced Phuket, like pool, it's really appealing, isn't it? It's just this amazing mix of stunning scenery and, a pretty great lifestyle. Owning a place there, maybe a villa or a condo, it's a common dream. But as you probably know, the actual cost goes way beyond just the price tag you see advertised. There are these other costs, fees, taxes, things that can really catch you out if you're not expecting them. And that's exactly what we want to unpack in this deep dive, our mission, to really break down those specific costs in Phuket. We want you to feel fully informed before you make any big decisions. And for this, we're drawing heavily on a great article, Phuket Property, Understanding Transfer Fees and Costs. It's from Ocean Worldwide. They're a luxury real estate agency. Have been working in Phuket and Koh Samui since, 2004? Yeah, and their director, Sandra O'Neill, she's helped literally thousands of families and investors. So it's really solid info. Okay, let's get into it. Someone's excited, thinking about buying in Phuket. What's that immediate financial nitty-gritty they need to grasp right away, beyond the sale price?
That's the perfect place to start. Because honestly, understanding these costs up front, it's not just about having the right budget. It's really about avoiding major headaches later on.
Right.
We're talking about things like the transfer fee, stamp duty, maybe business tax, withholding tax. And what's really crucial is how they're calculated. It's usually based on the property's appraised value or the actual sale price, whichever one is higher.
Okay.
And then you've got other things too, like legal fees, the annual property tax. And a really interesting point is the difference in costs if it's leasehold versus freehold.
Okay, let's break down those main transfer fees then. What's the first one, the most sort of straightforward one?
That'd be the main transfer fee itself. It's pretty standard, 2% of the property's appraised value.
Right.
You pay that directly to the land department, when the ownership officially transfers.
So if a place is appraised at, say, 10 million baht.
Exactly. That's 200,000 baht straight away for the transfer fee. It's a chunk you need to factor in from the start.
Makes sense. Okay, what about stamp duty? How does that fit in? Are there, conditions?
Yeah, stamp duty. It's typically 0.5% of the appraised value. But here's the key thing, the caveat. You don't pay it if the specific business tax is being paid on that same transaction.
Ah, okay, so it's one or the other.
Pretty much.
Yeah.
It's like an alternative tax. It kicks in when the business tax doesn't.
Got it. That leads us nicely to withholding tax. You mentioned that, and it sounds a bit more complex.
It definitely can be, yeah. Especially if you happen to be buying from a Thai company.
Okay.
That's when this tax usually comes into play. It could be 1%, sometimes more, of the property's appraised value. And interestingly, the buyer is actually the one who deducts this tax.
Really?
Yeah, you deduct it and then you pay it over to the revenue department, kind of on behalf of the seller.
Sounds like a bit of extra admin.
It is, a little. But it's just part of the process when you're dealing with a corporate seller. Like the article from Ocean Worldwide mentions, it's always smart to get specific advice on this part. Especially, if you're eyeing up something like a prime sea view plot in Kamala, for instance, you want that bit right.
Definitely. You've mentioned appraised value a few times now. How does that government appraisal usually compare to the actual price someone pays? And why does that difference matter?
Right. This is a really interesting aspect of the Thai system. The land department, they base all these fee calculations, the transfer fee, stamp duty, on whichever is higher.
Yeah.
The official appraised value or the actual sale price you register.
Okay.
Now, what everyone kind of knows in the market is that the government's appraised value, it's often quite a bit lower than the real market price you're actually paying.
Ah, I see.
So it's become a widely accepted practice for the buyer and seller to agree to register the sale price at something closer to that lower official appraised value.
And the reason?
It legally reduces the base for calculating those taxes and fees. So it lowers the overall tax burden for both sides. It's a bit of strategic planning within the rules.
That's fascinating. So once you understand these basic fees, what other things can change the final amount you pay? I think I read about a 5-year rule.
Absolutely. The costs aren't set in stone. Ownership duration is a big one. That's where the 5-year rule comes in, specifically for something called specific business tax.
Okay. Business tax, how does that work?
It's a 3.3% tax, and it usually applies if the seller has owned that property for less than 5 years.
Ah, okay. Like a tax on flipping, almost.
Sort of, yeah. If they've owned it for more than 5 years, then typically this 3.3% tax is waived. And instead, that 0.5% stamp duty we talked about applies.
So that 5-year mark can make quite a difference to the seller's costs, which might impact negotiations.
Exactly. It can make a really noticeable difference to the total transaction cost. We're talking potentially significant amounts of money depending on the property value.
And then there's the other big one, leasehold versus freehold. You mentioned the costs are very different. Can you break that down? Why is it such a big deal in Phuket?
Yeah, this is a huge point, especially for foreign buyers. If you buy a freehold property like a condo where foreigners can own freehold, the total fees and taxes can stack up. Maybe around 6.8% of the estimated value, give or take.
Okay, 6.8%, quite high.
It is, but now compare that to a leasehold transfer. The costs there are way lower, usually around 1.1%.
Wow, that's a massive difference, just 1.1%.
Yeah, just 1.1%.
Mm-hmm.
It's pretty simple how it breaks down. You've got a 1% registration fee, and that's calculated on the total value of the lease for its entire term, say 30 years. Plus, there's a small 0.1% stamp duty, again, on that total rental value.
Okay.
And someone transfers an existing leasehold partway through the term,
Right, what happens then?
then that 1.1% is just calculated on the value of the remaining time left on the lease.
That makes leasehold seem financially quite attractive, at least on the transfer cost side.
It definitely presents a different financial picture. It's a very common and viable option for many foreign buyers, especially for villas and houses where freehold isn't usually possible for them anyway.
Okay, so beyond those main transfer-related fees, what other costs should buyers be absolutely sure to budget for? You know, the things that might pop up and cause a nasty surprise.
Yeah, it's like you said, it's not just the big headline percentages. There are other bits.
Like servicing your car. Always something extra.
Exactly. And one of those extra bits that's pretty much non-negotiable is legal fees and due diligence.
Right, you definitely need a lawyer.
Absolutely. You need a local lawyer to handle all the paperwork, check everything, make sure it's all legit. This usually costs somewhere between 1% and 2% of the property price. It depends a bit on how complex the purchase is.
And that due diligence part, what does that actually cover? Why is it so vital?
Oh, it's critical. It's basically your safety net. Due diligence means your lawyer thoroughly checks everything. They'll verify the title deed. Is the seller really the owner? Are there any liens or mortgages? They check building permits, look into the developer's reputation if it's a new build, check for outstanding debts tied to the property, confirm the boundaries.
So skipping it would be unwise.
Extremely unwise. It's like buying a used car without even looking under the hood or taking it for a test drive.
Ah, okay, good analogy.
You might get lucky, but the chances of finding a serious problem later are just too high. It's an investment in peace of mind, really. Protects you from potentially huge mistakes.
Makes total sense. Okay, those are mostly one-off costs at the time of purchase. What about ongoing expenses once you actually own the place?
Right. Ownership comes with recurring costs, too. If you're buying a condo or maybe a villa in a managed estate, you'll have ongoing maintenance fees, sometimes called CAM fees, common area maintenance.
Ah, yes, for the pool, security, gardens.
Exactly. Covers all those shared services and upkeep. The cost usually runs about 30 to 50 Thai baht per square meter of your unit per month. Obviously, the fancier the place, the more amenities, the higher those fees might be.
And property tax, is it a big thing annually?
There are annual property tax obligations, yes. The good news for purely private residences is that this tax is generally quite low in Thailand, often around 0.1% of the official appraised value.
Okay, 0.1% sounds manageable.
It usually is. However, and this is important, it's significantly higher for properties owned through a company structure.
Ah, so that's another factor when deciding how to own the property.
Definitely. It feeds into that whole leasehold versus freehold versus company structure decision.
And with that annual property tax for private homes, you said it's low. Do you actually get a bill? How does payment work?
That's another interesting quirk. For private homes, even though the tax exists, you often don't receive an official bill every year. Enforcement can be a bit lax year to year.
So you could just not pay it.
Well, here's the catch. Any outstanding property tax absolutely must be paid up before you can transfer the ownership when you eventually sell.
Ah, okay. So it catches up with you then.
Exactly. The land department won't process the sale if there's unpaid property tax. So even if you don't get a bill, it's wise to stay on top of it, maybe check with the local authorities periodically or have your lawyer do it. Otherwise, it becomes a problem down the line.
Good to know. Be proactive.
Let's circle back to that business tax for a moment just to make sure it's clear.
Okay, yeah, the 3.3% one.
Right. Remember, it generally applies if the property is sold within 5 years of being acquired. It targets shorter-term holds. But There are specific exemptions.
Oh, like what?
Well, you're usually exempt if you're transferring the property to a direct legal heir or gifting it to your legitimate child.
Oh.
Or, interestingly, if you're donating it to a temple or a recognized religious institution.
Okay, so specific circumstances bypass it.
Correct. And just to hammer the point home, you generally don't pay both business tax and stamp duty. If that 3.3% business tax is due because of the short ownership period,
Then the 0.5% stamp duty is usually waived.
you got it. It's one or the other.
Right. Now, understanding the ownership structures themselves sounds like a really big deal for foreigners wanting to buy in Phuket, especially land or houses.
It's absolutely critical because, as you know, Thai law generally doesn't allow foreigners to own land directly in their own name.
So, how do they typically handle buying a villa, for example?
One very common method involves using a Thai limited company. It's often called share transfers in property companies. Basically, a Thai limited company is set up to own the land and the property. The foreign buyer then holds the majority of the shares in that company. Thai nationals need to hold a certain percentage of shares, too, to meet the legal requirements.
That sounds like a common workaround. How does the government view these setups? Is it all straightforward?
That's where you need good advice. It is a common structure, but the Thai government does keep a close watch on them. They're careful about ensuring these aren't just nominee structures, where the Thai shareholders are just names on paper with no real involvement, purely to get around the foreign ownership rules.
Ah, the nominee issue. I've heard about crackdowns on that.
Exactly. There have been periods of increased scrutiny, particularly in popular areas like Phuket, Rayong, and Koh Samui. They implemented measures specifically to address potential nominee ownership. So the key takeaway is, if you use this structure, it needs to be set up correctly, transparently, and legally from the very beginning. Getting it right avoids major problems later.
Okay, so for foreigners specifically, what are the main options then, if direct land ownership is out?
Right, let's summarize the foreign ownership considerations. Option 1, condominiums. Foreigners can own condo units freehold directly in their own name.
But there's a limit, right?
Yes, up to 49% of the total sellable floor space in any single condo building can be foreign-owned freehold. And crucially, the money to buy that condo must be transferred into Thailand from overseas. You need proof of that, a specific bank document called a Thor Tor Sam.
Okay, so condos are one path. What about houses or villas?
For houses, villas, land, the main alternatives are, number 1, a long-term leasehold, typically 30 years, often renewable for further periods. Or number 2, that Thai limited company structure we just discussed, where the company owns the asset and you own the shares.
Each with its own pros, cons, and costs.
Precisely. Different implications for control, complexity, long-term security, and of course cost.
So let's say a buyer understands all these costs now. Transfer fees, taxes, legal, ongoing. Then comes the negotiation, right? You mentioned that unlike some countries with fixed rules, in Thailand, who pays what fee is often negotiable.
That's right. It's not always rigidly defined by law who pays each specific fee, which can make it feel like, yeah, a bit of a puzzle sometimes. It's open for discussion between buyer and seller.
So how does it usually shake out in practice, say in a private sale?
Well, there are common practices, kind of market standards. For example, that specific business tax, the 3.3% one if owned less than 5 years,
Right.
that's generally considered the seller's responsibility. Makes sense, right? It relates to their ownership period.
Yeah, logical.
Stamp duty, the 0.5%, is also often covered by the seller. But remember, it's usually waived if business tax is being paid anyway.
Okay. What about the big 2% transfer fee?
That one is very commonly paid entirely by the buyer,
Yeah.
or sometimes it's split 50-50 between buyer and seller. That's a frequent point of negotiation.
And withholding tax.
Withholding tax is almost always considered the seller's duty to cover.
Interesting. And does it change if you're buying directly from a developer, like in a new project?
It can, yes. Developers often have their own standard practices. They frequently agree to cover the specific business tax and the withholding tax themselves as part of the deal. And sometimes they might only ask the buyer to pay half of that main 2% transfer fee, so just 1%. It depends on the developer and the market conditions.
So with all this potential variation and negotiation, the absolute key advice must be,
Get it in writing. Absolutely crystal clear.
right, no assumptions.
None. Whatever you agree on regarding who pays which specific fee and tax, it needs to be explicitly stated in the initial reservation agreement, and that it must be carried through accurately into the final sales and purchase agreement registered at the land department.
Spelling it out prevents any arguments or nasty surprises at the closing table.
Exactly. Avoids disputes, ensures a smooth transfer. Don't just rely on verbal agreements for this stuff.
Sound advice. Okay, one last practical point. Home insurance. You've navigated the purchase, paid the fees, got the keys. Why is thinking about insurance crucial right away?
Well, firstly, if you have a mortgage, the lender will almost certainly require you to have building insurance. It's usually mandatory.
Okay, standard practice.
But even if you buy outright with cash, no mortgage. It's just basic common sense, isn't it? You've just invested a significant amount in this asset, protecting against fire, flood, storm damage, whatever the potential risks are in that location. It just makes sense. It protects your investment.
What affects how much that insurance costs?
Several things. The size and value of the property, obviously. Its exact location. Is it beachfront? Is it prone to landslides? Also, the level of cover you choose. How comprehensive is it? And the deductible you opt for.
The deductible being the amount you pay first on any claim.
Right. And of course, the insurance company you choose will have different rates, so it pays to shop around.
Do you have a rough ballpark figure for annual costs?
Very rough, as it varies a lot. But as a general guide, you might budget somewhere between, say, 0.1% and maybe 0.2% of the home's rebuild value per year. So maybe closer to 1.2% isn't quite right. More like 0.2% is typical. So for a $5 million bad home, maybe 5,000 to 10,000 bad a year, perhaps a bit more for very comprehensive cover. It depends heavily on the specifics. The earlier 1-2% might be more for total value, including land and some high-risk scenarios perhaps, but rebuild cost is a common basis. Let's stick with the lower range as a general guide.
Okay, so maybe 5,000 to 10,000 baht a year for a 5 million baht place. Still an ongoing cost to factor in.
Definitely. And you need to decide on that balance between the premium you pay and the deductible you choose.
Right, the higher the deductible, usually the lower the annual premium.
Exactly. But then if something does happen, you have to find that larger deductible amount out of pocket first.
So it's about figuring out what level of risk you're comfortable self-insuring via the deductible versus paying more for a lower deductible and more immediate cover.
Precisely. What can you comfortably afford to pay out if the worst happens? That helps determine the right balance for you.
It's a personal calculation, really. What stands out to you when considering that balance for your own property plans? Something for the listener to think about.
Okay, so let's wrap this up. Buying property in Phuket, it's exciting, no doubt about it. But as we've clearly seen today, that initial price you see, that's just the beginning of the financial story. You've got those transfer fees, stamp duty, maybe business tax, maybe withholding tax, plus legal fees, due diligence, possibly ongoing maintenance, annual taxes, insurance. It's quite a complex picture, isn't it? Like planning a really big trip, you need to account for all the little extras, not just the flight and hotel. That's a good way to put it. And my final piece of advice would just be, always talk it through. Chat with your real estate agent, someone knowledgeable like Sandra O'Neill at Ocean Worldwide, for example, or definitely your lawyer. Clarify who's expected to pay what. Remember, those costs can often be negotiated. Get a really clear, itemized picture of the total financial outlay before you sign anything binding. Do that homework up front. And then you can genuinely relax and enjoy that beautiful new property in Thailand without any nasty financial surprises popping up later.
Excellent advice. So, reflecting on all this, what does it really mean for making smart property decisions? How might really digging into these detailed regulations, not just in Phuket, but maybe in other complex emerging markets, how might that empower you as a buyer? Something to think about until our next deep dive.